This podcast is a production of the Brickyard Network, an extension of the Archie Bray Foundation for the Ceramic Arts. To find out more about our lineup of ceramic podcasts, visit brickyardnetwork.org.
Hey, this is Erin with Cornell Studio Supply located in Dayton, Ohio, exclusive distributor of Jen Allen templates and Put a Lid on It t-shirts. We are a proud sponsor of this episode and the Brickyard Network. Find all your pottery and ceramic sculpture needs, including the largest stock of GR pottery forms at cornellstudiosupply.com. At Cornell Studio Supply, we are owned and operated for potters, by potters.
A special thank you to the Archie Bray Foundation for sponsoring this episode of Tales of the Red Clay Rambler. The Bray Clay business is your best source for Bray epoxy, a two-part moldable epoxy intended for post-firing repairs. Working like clay, it's easy to shape, texture, fill gaps, and recreate missing parts. Bray epoxy is sold in tan, white, and black base colors, and we also have a 9-color kit that will allow you to perfectly disguise your repair. To place your order, call us at 406-442-2521 or order online anytime at archiebrayclay.com.
Welcome to the Tales of a Red Clay Rambler podcast, featuring interviews with culture makers from around the world. This is Ben Carter. I'm going to be your host. If you'd like more information on the show, please visit our website, talesofaredclayrambler.com. Welcome back to episode 525 of the podcast. Thank you all for tuning in. Today we are starting a series on student loans. This is something that has affected myself and my family, and actually this summer I just paid off student loans that started when I was starting graduate school in 2007. So this was more than a decade-long quest for me to finally pay off my student loans. Now, as I have learned through doing research, I'm not alone. In fact, there is $1.75 trillion in student loan debt. That's trillion with a T. That is a lot of debt, all held by students that borrowed to pay for their education. To address this issue, I wanted to talk to someone that was an expert in the field of student loans. And thankfully, I've been able to talk to Betsy Mayotte, who over the last 3 decades has worked with hundreds of borrowers in her role as the president of the nonprofit Institute of Student Loan Advisors. In this interview, we talk about the factors that are driving up the cost of education, how a student progresses through a loan cycle, loan forgiveness options, and healthy habits for financial literacy. We also talk about the upcoming September the 30th deadline for the Fresh Start program. This is a new initiative to help borrowers get out of default. This is a topic that we cover towards the end of the interview, and Betsy points out that it's more expensive to default on your loan than it is to be on an income-based payment plan. This Fresh Start program is an easy way to get you out of default, so if you are struggling with your loans, don't ignore them. Now, the downside of that program is it only will exist till September the 30th, so if you are listening to this right now, I hope that you will take advantage of that. You can find out more about the Institute of Student Loan Advisors at their website. That's freestudentloanadvice.org. Without further ado, we'll get to the interview. Well, let's start just by having you introduce yourself. Can you just tell us your name and the institution that you work for?
My name is Betsy Mayotte, and I'm the president of a nonprofit organization called the Institute of Student Loan Advisors, or TISLA, if you don't want that full mouthful. Our nonprofit was founded specifically to offer free, expert, unbiased student loan advice to all consumers. So anyone can go on our website. You're not going to get any ads. You're not going to be required to create a profile. I'd like to think it's comprehensive and in plain English when it comes to student loans. And then if you have questions beyond that, you can email us. Again, always free. And we answer most emails within a business day. And we're happy to try to guide you on anything related to managing your student loans.
As I was doing research for this, I was looking at the rise in student loans, which is directly proportionate to the cost of education in the US. And some statistics that I just wanted to give to the listener. In recent years, the U.S. News and World Report, which is known for their rankings, they polled all the universities that are in their rankings, and they were asking about tuition increases for private schools, in-state tuition and out-of-state tuition. And for private schools, tuition is increased 40%. And for in-state public schools, it's 38%. So you're seeing this like huge rise in cost of education. Can you talk a little bit about why that's happening and how that affects how many people need student loans?
I love this topic so much. It's one that I wish that there was more conversation about, both in the media and at the policy level. Especially recently, we talk about the student debt crisis. And to be clear, I'm not minimizing that. We are in a student debt crisis. Student loans are not the problem. Student loans are the symptom of the problem. The problem is the cost of higher education. So, again, especially lately, there's a lot of focus on whether the Biden administration is going to be successful in doing any type of student debt relief. And that's important. And I hope he is successful in doing even more than what he's already done. But the fact of the matter is, even if he is successful, the loans are going to start accruing again the very next day. Addressing the student loans addresses, you're trying to heal the wound rather than trying to prevent the wound from occurring in the first place. So again, I'm delighted that we're talking about this. So the reason, there's a couple reasons for increased cost in higher ed. One of the main reasons that researchers that have looked into this is the fact that every single state has reduced the funding that is given to higher education in their states. So what that ends up doing is it increases the cost of what I like to call the anchor price schools. So if you look at this from an economic standpoint, the state schools, which are hypothetically supposed to be some of the most affordable while still providing a robust education, are sort of, from an economic standpoint, the anchor price. So if your state school, so let's look at Massachusetts. UMass averages 27 to 30 grand a year or so. Now, if your state school costs that much to attend, you've essentially given economic permission for your private nonprofit schools to charge, if they're charging $60,000, $70,000, $80,000 a year, that doesn't, it's outrageous, but it passes the laugh test, so to speak. If the state started reinvesting in higher education and now a Massachusetts state school costs $10,000 a year, the fact that the private nonprofit is charging 60, 70, or 80 no longer passes the laugh test, right? So that's one of the biggest reasons that the cost of education has gone up so much. The other side of the coin is schools have no skin in the game when it comes to student debt. If you get a degree and the return on investment is not there, they still got their money. If the loans get forgiven later because the borrower couldn't afford to pay it in a reasonable amount of time, based on their income that they're making from that degree, school still got their money, and none of that money is taken away because some of that debt has been forgiven. And, this is probably going to get me taken off some Christmas card lists, but I think the time has come for schools to have some skin in the game, and that would force them to be a little more thoughtful about their own return on investment when they're planning on tuition hikes or increases and so on. And that is not, it's not a new idea. The Democrats specifically have sort of been, I'm not going to say shouting about it because they haven't been shouting, but chattering about schools having skin in the game for decades. What is new is that the Republicans are starting to talk about it now too. So this is actually, and in this day and age, this is the dodo, a rare bird. We've got a bipartisan issue here. Congresswoman Virginia Foxx, who chairs the House Education Committee and has since the earth cooled, part of her legislative agenda this year includes a proposal that would have schools have some skin in the game.
And what would that look like for the borrower? Like, how would that work?
Well, there's a lot of different proposals out there. To be candid, I don't exactly remember what Congresswoman Fox's proposal was. It's been a minute since I looked at it. So I can look that up and provide it to you after our recording if you like. I actually wrote a legislative proposal many years ago about this. And what my proposal, and I've seen similar proposals to this since then. What my proposal was if the school's default rate, so the percentage of borrowers that defaulted on their loan was higher than the national average, then the school would be required to give back a percentage of the loans that they received for that cohort. And that money would specifically be earmarked to provide additional services for struggling student loan borrowers. I know there's been other proposals that directly targeted for-profit institutions. They're like the redheaded stepchild of the higher education world, where, and this gets really in the weeds. You might not want to go that far in the weeds, but there's certain programs that are designated as what we call gainful employment programs. It tends to be most of the programs at for-profit schools, and at nonprofit schools, they tend to be certificate programs. And the way it would work is if the earnings of people graduating with those gainful employment programs was low, say compared to someone who didn't have a college degree at all, then again, the school would be required to give some money back.
I think what this does is it helps to look at the education system as an ecosystem where the school, the borrower, and the lender are all part of this ecosystem. And a lot of the student loan crisis, at least from my end, the people I've been interviewing, which are artists that have these student loans, a lot of times they feel totally isolated once they graduate. It's just the debt. That's all they have. They don't have help from the school. They don't necessarily have help even from their lender to explain a lot of the details. They just know you got to make the payment on time every month.
Well, and that's one of the reasons I started TISLA. But just to add clarity to what you're talking about, the vast majority of student loans, there actually is no lender. Your lender is the U.S. taxpayer. Private loans can be the most difficult to manage, but thankfully, when you look at total student loan debt in the United States, private loans are actually a very small portion of those loans. So, people like to talk about the lenders with student loans, but again, the fact of the matter is that for most loans, the lender is the federal government, which essentially it's the U.S. taxpayer.
Can you talk about, like, let's say for someone who's 18 that's getting ready to go into undergraduate school right now, and they want to go to the school, but they can't pay for it independently. Can you talk about the things they should be looking at as they prepare themselves to get their very first student loan?
Unlike other purchases, choosing your college tends to be a lot more an emotional decision rather than a financial decision. And I've worked with people, most of the people I work with is the back end, the people that already have the student loans. But when I do talk to people that are making the college decision or trying to figure out how to pay for college, oftentimes they're willing to sell a kidney, whatever it takes. I have to go to the school. The school's the only one for me. I'll just die if I don't go to the school. Well, I want to throw some data at you. 70% of undergraduates change schools or majors before they're done. So while that school may feel incredibly important to you right now, chances are it might not be as important to you down the line. And you need to treat this like you treat any other financial decision. Unfortunately, the days of education for education's sake are gone, which is incredibly sad. in and of itself, but that's just what it is. You need to look at ROI. And I see a lot of people who say, I'll worry about the money later. You can't worry about the money later. You have to worry about the money now. Those same people end up coming back later saying, what have I done? I'm overwhelmed. I'm depressed. My debt owns me. I wish I never did this. I very rarely see anybody be really glad that they took out a bunch of student loans. But there are still ways to attend your dream school. I strongly recommend people do their first year or two at a lower price school and transfer into the dream school. Community college, you can often attend for free or for very low cost. And for just about any degree, the first year or two of credits are the same for everybody. So why would you pay $60,000 or $80,000 a year when you can get the same credits for free or practically free at the community college and then again transfer into the dream school? And the other nice thing about that is if you do change your mind, you've got that lower cost under your belt rather than the higher costs that you've already attended. The other thing I recommend that people do, people don't love this idea, is go part-time and work and pay as you go as much as you can. It's going to take you a little bit longer, but is worth it not to have student debt hanging over your head for 10, 20, 30 years. And finally, when you are looking at the debt, I really wish people would stop looking at it from the big number standpoint. So if you see that you're going to be borrowing 20 grand your first year, I don't want you to look at it at the 20 grand. I want you to multiply that by 5 because A, that's the average time it takes to complete a 4-year degree, and B, there's likely to be tuition increases. So now we're at 100,000, and I don't care how financially literate you are, 100,000 doesn't click. You need to translate that out to what the monthly payment is going to be. So back of the napkin, what we usually say is for every 10 grand you borrow, you should assume around $125 a month for 10 years. So if you've borrowed 100 grand, math is not my forte. You're looking at around $1,300 a month every single month for 10 years. So plug that into what your anticipated income is going to be when you first get out of school and what rent is and cell phone plans and Netflix and car payment and car insurance and health insurance. And is $1,300 something that is palatable?
I'm so glad you gave a common sense formula with the way that you can think about that, because that 10,000 number is interesting. I think for art schools, people fall into a couple categories. There's the big public institutions like University of Florida, where I went, but then there are also these private institutions. The Kansas City Art Institute is a very famous one for ceramics. It is extremely expensive. And so we're talking about not $100,000 being borrowed. We're talking about like $250,000 over the course of a 4-year. I actually don't know the specifics on that school, but it is reasonable to think that you could have a $250,000 debt. So one of the things that I wanted to have you help explain is if you get a federally backed student loan, there's often a subsidized or an unsubsidized option. Can you just talk and explain about what that means for the borrower?
Yeah, so undergraduate students can borrow subsidized loans and unsubsidized loans. Subsidized loans are based on need. So if your family has, I'm going to air quote the word high because what they consider high and what we might consider high are two different things. They wouldn't be eligible for the subsidized Stafford. They'd only be eligible for the unsubsidized. Subsidized Stafford means that the government is paying the interest for you while you're in school at least half time and during your grace period and if you end up taking a deferment down the line, they'll pay for the interest during that deferment. Unsubsidized loans means that the interest is accruing right from day one. From the moment that money is dispersed, the interest is accruing on a daily basis. And you're not required to pay that while you're in school, but it keeps accruing. And if you don't pay it, when you first leave school, they take all that interest that's accrued while you're in school, and they add it to your principal balance. So now you're accruing interest off of interest. So I don't know if I've ever seen a borrower that didn't have at least one unsubsidized loan. So if you're within the sound of my voice and you're in school, pay the interest while you're in school. It's going to save you a ton of money in the long run. And it's also going to get you in the habit of repayment, which, believe it or not, data shows that the people that tend to be the most successful managing their debt and not defaulting has less to do with how much you make and more to do with literally just getting in the habit of making the payment.
One of the things that is always confounding to me is that what banks pay each other to borrow money is often much, much, much lower than what students pay in interest to borrow from the federal government. So can you just explain interest rates as it pertains to this?
Yeah, it's a little complicated. So let's start with the easy one, which is private student loans. Private student loans, you often have a choice of a variable interest rate or a fixed interest rate. But what both of those have in common is that they're always based, they're based at least in part on the market. So if market interest rates are high, even if you have excellent credit and Warren Buffett is your co-signer, then you're going to have a higher interest rate than someone who borrows next year when maybe the market interest rates are lower. It's not dissimilar it's the same for mortgages. The mortgage rate you get is based partly on your credit, but also partly on the market. Federal student loan interest rates are a little more complicated. I've been working in the student loan industry in a compliance and advocacy role for over 25 years. And Congress is the one who sets the interest rates on federal student loans. And the scheme they've used has changed back and forth since back in the 70s. Some years they've been variable, some years they've been fixed. They are always based a little bit on the market. I'm very much overgeneralizing because no one wants an hour-long discussion on the history of student loan interest rates, including myself, and I love talking student loans. But in general, the sort of base of these rates are based on the 90-day Treasury bill for a long time. That's what they were based on, or the 52-week Treasury bill. Since 2006, anybody who's taken a loan out since 2006 on a federal loan, the rates have been a fixed interest rate, and the rate that you get is based on when you took the loan out. So they set the rates for loans dispersed on or after July 1st until the following June 30th. So that's why, the rate you have for your freshman year loan is probably going to be very different from the rate you have from your junior year loan. If you have loans prior to 2006, unless you've consolidated, then you have a variable rate that changes every July 1st, but it does have a cap. The cap differs depending on the loan type and when you took it out, and blah, blah, blah.
This is kind of a broader question, but do you think that the government, in terms of our education policy, thinks of student loans as a money-making effort? Why would they change rates year to year if they didn't think about it as a money-making effort?
The federal government has their own borrowing cost, and there is a cost to servicing these loans. And there is a cost to forgiving some of the loans, like through PSLF. And there is a cost on the loans that they never end up collecting on because people default and then run away to the desert and no one ever finds them. So they do, there's a lot of people that say, well, the way to solve this is Congress should just get rid of interest. But, student loan debt is part of the federal budget. So if you forgive all the student loans or if you totally get rid of the interest, then that means other things in the budget have to be cut. Because we've been at a zero-sum game, if we're lucky, with the budget for well over a decade now. So, for example, back in 2000, so prior to 2010, there used to be two federal student loan programs that were both exactly the same, except where they were different. We had the Federal Family Education Loan Program, or FFEL, and we had the Direct Loan Program. They both had Stafford loans. They both had Parent Plus. They both had Graduate Plus. Both had consolidations. They both had the same interest rates and benefits for the most part. And Congress decided in 2010, under the Obama administration, to get rid of the FFEL program because they saw that as a savings. And they used that savings in that year's budget, 10-year projection in the future, to pay for Obamacare.
Okay.
Now, the reason I laughed when you first asked me this question is, remember, I've been doing this since the dinosaurs roamed. And over my career, I've seen the way that they account for student debt in the budget in different ways. And depending on how they account for it will depend on whether they say student loans make the government money or whether student loans lose the government money. So again, I'm a one-trick pony. Student loans are my trick. I am not an accountant and I don't play one on TV. So, but there's two basic accounting methods. And at one point, it showed that student loans made the government money. But then they switched to the other accounting method, and then all of a sudden they were losing money. So I will never in my life believe any costs associated on the federal budget level when it comes to student loans. I think that will forever remain a mystery. They will find for sure where Amelia Earhart is and who killed John Benet Ramsey well before they ever actually figure out whether student loans make the government money or not.
We'll be right back after a quick word from our sponsors. Today's episode is brought to you by the Rosenfield Collection of Functional Ceramic Art. The collection exists as an online resource for research and inspiration, featuring photos of over 4,000 objects made by over 1,000 artists. The images are high quality and can be used with no permission required, making them a great resource for students and teachers. To find out more, visit rosenfieldcollection.com.
Hey folks, Sunshine Cobb here, ceramic artist and current resident coordinator at the Bray. I'm excited to announce that our application portal is now open for our 2025 residency cohort. Applications are due by December 19th, 2024. For details on all our residencies available, head to archiebray.org/residencies. Please help us spread the word about this amazing new opportunity at the Bray. Thanks so much.
So going back to the rising cost of education, you mentioned that there is less support at the state level and federal level for individual schools, which makes the cost go up. How do you think as a society we can get politicians to change course on this, to actually fund schools better on the front end so that the student loans that we take aren't as impactful in our lives?
The Biden administration tried to do that, and it went over like a lead balloon. The name of the legislation escapes me now, but he promoted it, I think, his first year in office, and Congress didn't want any part of it. So, again, this becomes a budget issue. They essentially have to offer incentives to the state, or, whether it's a carrot or a stick. I think I saw a proposal at one point that would have threatened state like highway budget funding if they didn't reinvest in higher ed. Again, that legislation didn't go anywhere. But this is another bipartisan issue about one side of the aisle doesn't necessarily think it's the state's responsibilities to support higher education, and that it's ultimately the family's responsibility to pay for higher ed. And then, of course, the other side of the aisle does firmly believe that the cost of education is too high and it's something that needs to be addressed at the policy level.
As students are progressing through school, once they graduate and they now go into, I guess they have their grace period first, and then they go into repayment. Can you talk a little bit about this transition? Because I feel like some students are getting lost, even at this point, even at the very beginning, they're getting lost. So can you talk about that first era of repayment, what they should be thinking about?
Part of the reason that happens, so anybody who takes out a federal student loan is given entrance counseling when they take out their very first loan, and it explains all the things. And then when they first leave school, they're given an exit counseling. Something like 40% of borrowers will swear to you on their childhood dog's grave that they never got exit counseling. I guarantee you they got exit counseling, but they either failed to show up, in which case they got it in the mail and didn't read it, or they just simply don't remember it. I'm old. I remember my exit counseling. You know what I remember about it? I remember being put in a room with a VCR. Told you I was old. And the only part of that video I remember is an old man in a suit walking in a park telling me I should pay my student loan back because it made me a good citizen. That's the only part of my exit counseling I remember. The point I'm trying to make is the counseling is good, but it's given at the wrong time. The key to student loan counseling is providing the right information at the right time. Having someone go through entrance counseling when they've already chosen their school, have moved into their dorm and put their, again, I'm going to age myself, REM posters on the wall, nothing they're going to get in entrance counseling is going to change their mind, right? It's too late. They should do entrance counseling as part of the FAFSA when people can use that information to make educated choices about college and funding college. Exit counseling is the same thing. They're giving it to you as you're graduating. So you're trying to get those REM posters off the wall, do your finals, figure out where you're going to move to, figure out your job. And your first payment's not going to be due for another 6 or 7 months. You should be doing exit counseling like 45 days before your first payment is due. So yes, people get lost, but that's why they get lost. They're not being given the right information at the right time. The best thing I can advise people to do, and this is the perfect time of year for it, because recent grads are their first payments coming up in October or November. Read all the things. Thankfully, just even in the last 5 years, the information that's available online to people and the tools, so much better than it used to be. Studentaid.gov. If you're going to bookmark one website, studentaid.gov. It'll tell you all the things, and it has some great tools to help you figure out both short-term and long-term for payment plans. Shameless plug, our website, as I mentioned, I'd like to think it's in plain English. Don't use our calculator right now because I need to update it once all the court shenanigans are over. But other than that, I'd like to think it's comprehensive and in plain English. And talk to your loan servicer. They're the ones that hold your loans, and they are the ones that are going to know best what you're eligible for and what you're not.
I'm glad you brought up loan servicers because I took most of my student loans for graduate school. And since I graduated in 2010, my servicer changed 4 times. And one of the things that happened with those loans is that when that transferred to the new servicer, there was always a point of lack of information, is a generous way to say it, where I would call the new servicer and ask them a question, and they would say, "We're not sure yet. We haven't got all the information from the old servicer." But this happened over and over for years and years. So can you talk about what the role of the loan servicer is in these federally backed student loans and why they change so much?
The Department of Education, considering there's 40 million student loan borrowers, like many federal agencies, they don't, for the most part, do their own servicing. They hire vendors to do the servicing for them. And even back in the days where most federal loans, there was an actual lender involved, those old FEL loans, you know, Bank of America didn't service their own student loans. They hired a loan servicer to do it for them. Now, the loan servicers, they don't get any interest. They get paid a monthly fee based on the status the loan is in. So they get paid the most money per month on a loan that's in repayment and in good standing. They get paid the least amount of money for a loan that's, say, in forbearance, where the borrower isn't paying at all, or a loan that's delinquent. So despite what a lot of people think, it's actually in the servicer's best interest to service your loan well and give you good information, so you are in good standing, because again, they make the most money that way. And it's, there's a lot of people think, well, they purposely give misinformation so they can get all that extra interest. They don't get it. The U.S. taxpayer gets it. So that actually isn't in their best interest. The reason that you experience so many servicer transfers is, quite frankly, because a lot of so there used to be something like 16 different loan servicers, and now there's 4. Because a lot of them took their toys and went home simply because the contracts were not sustainable. Never mind. So a lot of the not all of them, but a lot of the servicers were nonprofits. But just because you're a nonprofit it still means you have to meet your bills. You have to at least be breaking even. And the fees that the servicers were getting just it was not cost effective. So that's why we're down to 4. And that's why your loans And also, if you consolidated at any point, your servicer might have changed for that reason too. Or if you defaulted or anything like that, your servicer may have changed. But people should be seeing we're going through a little bit of a transition again right now. They're taking a bunch of volume away from one of the servicers, Mohila. But other than that, people should not expect their loans to move very much anymore because there's really nobody to move them to.
You brought up consolidation, and I'm glad you did. That's something that I didn't do because I didn't quite understand how to do it. So, can you talk about what consolidation is and what is actually getting consolidated when you move from the multiple loans to one?
So, there's two different terms I'm going to use here. One is consolidation, one is refinancing. When I say consolidation, I'm talking about federal loans. When I'm saying refinancing, I'm talking about private loans. And here's the difference. When you refinance a private loan, just like when you refinance a mortgage or if you refinance a car loan or something like that, you're what you're doing is you're paying off your existing loans with a brand new loan. And you generally are getting a different interest rate, hopefully a lower interest rate, and you're getting different terms. When you consolidate a federal loan, what you're doing is once again taking a bunch of individual loans and paying those off and creating one great big fat new loan with a longer term. But you're not getting a lower interest rate. What they do is they do a weighted average of the interest rates of the loans you consolidated, and then they round up to the nearest eighth of a point. So it's a wash. I see a lot of people go, I don't want to consolidate because it means I have a higher interest rate. You really don't. It might look like a higher interest rate, but it should be a wash because it's a weighted average of the underlying loan rates. Consolidation used to be very popular because remember I said prior to 2006, interest rates were variable. If there was a year where the variable interest rate was really low, which happened in the early 2000s, the only way to lock in that crazy low interest rate was to consolidate because consolidation loans always have a fixed interest rate. So back in the early 2000s, it became the trend. Everybody was told to consolidate, and rightly so, because again, the rates were down to like 2% for 1 or 2 of the years. But now that interest rates for loans made after 2006 are fixed, most people don't need to consolidate. If you have all direct loans and they were all taken out around the same time, unless there's parent plus loans involved, most people actually aren't going to benefit by consolidation. It doesn't mean it's a bad thing, but there's still a lot of people that think, oh my God, I have to consolidate. You probably don't. But the way to do it, so normally I would say go to studentaid.gov and just do it online, super easy. Because of the current court shenanigans, you can't do it online, but you still go to studentaid.gov and you can download the paper application, all old school and stuff. And you fill out the paper application. And again, old school, either snail mail it or fax it to the address that they give you.
Let's, for a hypothetical reason, say that someone can't pay their loans. They see that that train is coming down the track and their life is going to fall apart and they're going to default. Then what do they do? Like, what should a student do if they see default looming on the horizon?
They need to do whatever they can to not default. And there are so many options. There are many lower payment options, some based on income. And if your income is very low, you could have a $0 payment under these income-driven repayment plans. Now, I'm going to add a little asterisk footnote to that. Right now, again, because of the court nonsense, you can apply for an income-driven plan with a paper application, but they're not processing any. Those will open up in the coming months. So there's those. There's also payment plans not based on income. There's some that are interest only for a couple of years. There are some that are lower the payment by extending the term. So you can get on a lower payment option. If none of the lower payment options work for you, you can get a deferment or forbearance and temporarily pause payments altogether. Now, there are people that say, I'm just not going to pay. I'm going to let it default because I can't afford any of those options. And my response to that is if you can't afford those options, you're really not going to be able to afford your defaulted loan because the income-driven plans, most of them are 10% of your adjusted gross income minus the poverty level based on your family size. If you default on your loan, they're going to garnish 15% of your gross income. So again, if you say you can't afford any of the income-driven plans, your financial life is going to be harder when you default. And to add insult to injury, in addition to that, interest is still going to accrue, of course, but they can add up to 24% of the balance in collection costs when you default. So again, defaulting is never, ever the solution because it's going to be much harder on you financially. Now, they can also garnish, and they will garnish your tax refund. They'll garnish your Social Security. And of course, there's a huge ding to your credit score. I'm going to take advantage of the talk of defaulted loans to bring up a really important deadline that's coming up in the next few days. The Biden administration, one of the many things they've done to try to help student loan borrowers is they created this temporary program called Fresh Start. And they use their authority under the COVID waivers to do it. This Fresh Start program ends on September 30th. You have to sign up by September 30th. We have never seen this program before. We will never see it again. But essentially what a Fresh Start does is you can get your federal student loan out of default by making a phone call. And it's going to take the default line off your credit report like it was never there. Huge. There's no additional collection costs added, which normally the options for getting out of default, they does add some collection costs to it. And it's immediate. It happens like within a month. So if you do have a defaulted federal loan and you don't take advantage of the Fresh Start program by September 30th, there are some borrowers that will be stuck in default forever. And those that aren't will either have to consolidate out of default, which adds 18% in collection costs and doesn't take the default off your record. It has to fall off after the 7 years. Or you can go through loan rehabilitation, which takes about 10 months, and that adds 16% in collection costs. And that does take the default line off your record, but again, it takes 10 months. So anybody who's in default would be crazy not to take advantage of this Fresh Start program. And September 30th is a hard stop for it. And you can find out more information at either our website or studentaid.gov.
I'm so glad that the Biden administration has made student borrowers a contingent to talk to and to provide programs for, and to try to right some of the programs that didn't work exactly right. So I have some questions about student loan forgiveness, and please correct me if I'm describing these things wrong, because I don't have all the facts down to the letter. But my understanding is that student loan forgiveness as an idea has actually been around for a while. But a lot of times the programs for student loan forgiveness were really, really hard to get into. In fact, one of the artists that I interviewed for this series, when he first applied for student loan forgiveness, I can't remember how many years ago this was, maybe 8 years ago, he was told he wasn't eligible for it.
He wasn't. You know how I know that? Because you said it was 8 years ago.
Okay, so give me a timeline and talk to me about how the idea of student loan forgiveness has progressed.
So you're right. Student loan forgiveness is not a new idea. Fun fact, there's actually over 100 student loan forgiveness programs out there. Most of them are state-based, but not all. We keep a database on the resources link of our website. We call it the almost complete list of student loan forgiveness programs. We update it about twice a year. We're actually in the middle of doing the biannual update as we speak. But public service loan forgiveness is probably the most well-known. That was written into law in 2007 by Bush II. A lot of people call it the Obama forgiveness program. I think it's but it was actually written into law by a Republican president. So the idea behind public service loan forgiveness is Congress they were hearing from professions such as teachers, public defenders, social workers. And what those professions have in common is that you almost always need a degree beyond an undergraduate degree to practice in those fields. And that's where you really rack up the debt, right? But those fields also tend not to pay very well. So they were hearing from constituents that were saying, we have a passion for these fields, but based on how much debt we have to take on to get the education we need, to get the credentials we need to practice in those fields, we can't afford to work in the fields. So they wanted to create a program to encourage people to not only enter into those fields, but stay in them. So what PSLF does is that if you are working for an eligible PSLF employer, which is any government employer, federal, state, local, or tribal, any 501c3, or there are some other nonprofits, few and far between, that do count, while making payments based on your income for 10 years, really 120 payments. If there's anything left over, they'll forgive it. Now, that means that the earliest anybody could have possibly qualified for PSLF was 2017, and that's late 2017. The other piece I want to throw in there is, remember I was saying how in 2010 there used to be 2 federal student loan programs, and they got rid of the FFEL. Congress only ever made direct loans eligible for PSLF. And up until 2010, the vast majority of loans being made were under the FFEL. So really, we weren't going to start seeing people getting forgiveness under PSLF till well after 2020. So PSLF has a bad rap. The last piece I'm going to mention on this is, up until fairly recently, there was not great information out there about PSLF. So people just had this vague understanding, if I work for public service for 10 years, they're going to forgive my loans. Well, turns out they didn't have the right kind of loan, or they hadn't been working 10 years. So it's true that up until this administration, only like 1% of people were getting approved, but that's because they weren't eligible yet. They hadn't, if you look at the data from back then, the vast majority of people getting denied literally hadn't been in repayment for 10 years yet. Never mind whether they'd been working for eligible employment for that long yet. So it was really, it wasn't that it was hard to get, just people didn't understand what the rules were. And now those rules are much clearer. And enough time has passed where people legitimately have had time to work long enough to get the forgiveness. But then other forgiveness programs, like there's a program specifically for teachers that's been around since 1998. There are federal forgiveness programs for healthcare workers that have been around since the mid 90s, if not earlier than that. So yeah, there's the oldest income driven plan was actually created back in 1994. So the idea of student loan forgiveness after a period of time and or service is not a new idea.
So for folks that are going into graduate school now, you mentioned that that's often a time in which they're going to get a lot of debt. A lot of folks that get in my field, in the arts, that get a graduate degree is because they want to teach. So there's almost a linking of, you get a degree, then you get PSLF, hopefully, and then it's forgiven and things are good. So there's almost a connection in the field between these two programs. Can you talk, though, about, for someone that maybe is not going to go into teaching, how they should negotiate graduate student loan debt? Is there anything different about the way a graduate student should look at debt than, say, an undergraduate student when they're coming out?
No, I'd like to go back to what I said earlier is, and this includes the borrowers that are like go into debt just assuming PSLF. Should never, first of all, never borrow assuming forgiveness. And I don't say that because I think PSLF is going away. I don't. Regardless of the outcome of the election, by the way, I do not think PSLF is going to go away. I've worked with thousands of borrowers in my career, and sometimes life happens. I've seen a number of people that, let's use teaching as an example, or maybe nursing, or maybe public defender or social work. They get into it and they're like, oh, I hate this. And now I feel trapped because I have all this debt and that I took on assuming PSLF. People decide, they end up not being able to get a job at a PSLF eligible employer. People's income ends up being higher and they feel like they got gypped. This is a good opportunity also for me to say, we get all caught up in the word forgiveness. And listen, I get it. I am a sucker for buy one, get one free at the grocery store without doing the math myself. But that's not the goal. Forgiveness is not the goal. The name of the game is paying the least amount out of your own pocket over time. And for some people, that means pursuing a loan forgiveness program. For other people, that means paying your loans off aggressively yourself. Believe it or not, I've seen people who actually spent more out of pocket pursuing a forgiveness program than they would have if they had just paid their loans off aggressively. The average student loan debt in this country is $37,000. So we always talk about the six-figure debt, and they're important, but the average Joe doesn't owe that much. And, I'd like to think that if you owe 37,000, I mean, that's no joke, but it's attainable to pay that off in less than 10 years and save yourself some money in interest. There's never a prepayment penalty on student loans. And the quicker you pay them off, the less you do pay in interest. So I wanted to make those points. So if you're, but if you're a grad student, again, I go back to what I said earlier, don't assume forgiveness and then think about the debt in terms of what the monthly payment is going to be over 10 years or 20 years or 30 years. And is that palatable to you? The last thing I want you to consider, if you're still on the PSLF track, and again, PSLF is an incredibly important program, and I think people should take advantage of it. But people, again, you shouldn't borrow with assuming that forgiveness. Sure, maybe you borrowed 150,000, and by the time you fulfill the PSLF obligations, maybe you get 60 grand forgiven. Great. But did you forego a higher salary for 10 years where you would have made an additional 100,000? So you just threw away 40 grand to get 60 grand forgiven. So you got to do the math.
I wanted to end talking just about resources that will help people with financial literacy as well as literacy about loans themselves. I know that there's a lot of resources on the website, but are there any other things that you can recommend to people? So for instance, are there any courses that a person can take that will help them increase their financial literacy?
Another website I want to recommend is another nonprofit. This is more for people that are going into school now, and I call them our fraternal twins. So this is another tiny nonprofit. They are always free to consumers. It's called Mapping Your Future, and I believe their website's mappingyourfuture.org. So they offer free advice. They have a lot of incredible resources on their website, including broad financial literacy, but they focus on paying for college, hopefully without debt. So I would recommend that website. I know this is a listen-only podcast, so for those that can't see it, what's happening right now is Alice, the student loan cat, is batting me in the face with her tail. So I apologize for the distraction. And Ben can see it, so he's laughing at me, and rightly so. There's another nonprofit I like that focuses on financial literacy. It's more for younger people, but listen, financial literacy, money's money. It's called the Jumpstart Coalition. Some states have done a good job putting state programs together. I believe Georgia might be Georgia comes to mind. And then there are some, federal agencies like Consumer Finance Protection Bureau, Federal Trade Commission. They've offered some courses as well. So their financial literacy stuff is out there if you look for it, and you can get it for free.
Yeah, because one thing that I would love to see going forward is in the same, when I was in high school, we took home economics, and it was literally things like cooking and sewing. I mean, I sound so old right now as I'm saying this, but home economics, I wish that there were classes on just simple financial literacy for teenagers so that when they get to this first because a lot of times student loans are the first big loan that any at least U.S. citizen is taken. So a lot of times they're going into this with half-truths and fantasies in their head, myself included. So I think financial literacy is always a good thing.
I agree with you. In fact, if I had my way, I would pass legislation that required every student in college, well, high school, elementary school too, but be required to take a 1-credit course on financial literacy. I think that should be a requirement that the school has to offer if they're a school that takes federal funding. I think they should require a 1-credit financial literacy course. Money's a funny thing, right? I did some research years ago, and one of the data points that I found, which was really intriguing to me, is that did a survey of, I don't remember how many parents, and something like 60% of them said they'd rather talk to their kids about sex than money. So in addition to like curriculum in elementary, secondary, and higher education, providing financial literacy, families should be talking about it and they should be learning it at home. People ask me how I ended up in this career, and my stupid joke is that my father worked for credit unions and my mother was a teacher, so education financing was in my genetics. But so dad worked for many years for a community-based credit union. And one of the programs he instituted that credit union still has in place to this day is they went to, the city they were in, and they actually opened a branch of the credit union at the high school, and the students worked at it, and the students all got really excellent rate savings accounts. And part of the give back to that is they provided financial literacy courses to the students. And that project has been incredibly successful in providing really robust, on the ground, not just curriculum, but real life financial literacy.
I can't even imagine that. That was in Massachusetts?
Yeah, Jeanne d'Arc Credit Union.
To wrap up, can you just leave the website for your institution so that people could get in touch if they would like to talk any about this or to get your free student loan counseling?
So our website is freestudentloanadvice.org. And the other website is studentaid.gov, which is the Department of Education's website. Those are the two you should have on hand.
Well, thanks so much, Betsy. I really appreciate this.
Yeah, my pleasure.
I'd like to thank Betsy for coming on the show. As you could hear, she has an easy and funny way to talk about student loans, which for me were something that were always frustrating and a little bit shameful to have. So I appreciate her clarifying a lot of things, and I hope that will help folks going into the future. Before we go, I'd like to thank today's sponsors. That's Cornell Studio Supply, the Rosenfield Collection of Functional Art, and the Archie Bray Foundation. If you or your organization is interested in becoming a sponsor on one of our shows, you can get in touch at brickyardnetwork.org. I'll be back next week with a continuation of this series where I'll be talking with artists about their experience with student loans. As always, thanks for tuning in. If you'd like more information on the artists on the show, or if you'd like more information about the workshops and events that I'll be having in the next couple months, you can follow me on Twitter, Instagram, and Facebook under Carter Pottery. Another great way to support the show is to leave me a comment on iTunes. To do that, search Tales of a Red Clay Rambler under iTunes Podcasts, and you'll find a page that's linked to our show. Thank you guys for the support.